We're taking a look at the market impact of the assassination attempt on former President Trump. Joining us right now is Paul Hickey, Bespoke Investment Group's co-founder. And Paul, this morning we are seeing futures up. You're seeing longer-term bond yields higher this morning as well, and Bitcoin very strong. What do you think the implications of all of this are?
So, I think the event in and of itself may, that isn't really impacting the markets much. But I think what longer range is, unless something changes in a big way. Going into the Super Bowl in 2008, the Patriots were undefeated and the Giants ended up beating them. So there's always a chance. But at this point, unless something changes, there's a very high likelihood that Trump will be elected in November. And there's good chance that an increasingly high chance that the Republicans will take the House and the Senate. And I think in that environment, it's mildly positive reaction from the markets, as we'll have a less repressive regulatory environment, and you'll see, more companies more likely to engage in M&A without having that overhang of the regulators, coming in and blocking transactions.
Higher yields in the bond market. What's that telling you?
So I think when you look at unified control by either party in the House, the purse strings become looser. You've had, since the 60s, you've only had 3 sessions of Congress where Republicans have been in full control. And in those periods, those 2-year periods, the 10-year yield did rise, not by a ton. The median increase was 20 basis points. So I don't think it's too surprising to see that you start to see interest rates rising a little bit here. And I think sentiment, you're going to see wide broadening out of the rally. If you look at after Trump was elected in November 2016, small caps in those initial months really performed well, doubled the performance of the S&P 500. During his administration, the performance was right in line to slightly below large caps, but we didn't have this really wide performance disparity that we're seeing now between the mega caps and everything else.
It was interesting. There were some comments that were being made just over the weekend, people taking a look at what this means longer term for spending. Again, hard to play that out, but you really do think that there would be more spending than we've already seen under a Democrat?
Well, no, not necessarily more spending, but the tax, we're not likely to see the tax cuts, the 2017 tax bill expire. So that's one thing. But it tends to, the parties get through more of their, what they want. And Washington loves to spend. No matter which party that you see over time. So I think it's just, you've seen the curve steepen as Trump's odds have increased since the debate. And so I think you're just starting to see a continuation of that trend.
You make an interesting point that not necessarily for the energy stocks. That's the one point that you don't think would necessarily benefit from this, which, again, President Trump was all about making sure that the drillers could drill. You bring up that while that is good for consumers, it's not necessarily good for the oil stocks themselves.
Yeah. So, if you look during, Trump is very friendly to the energy sector. During his administration, it was the worst performing sector of the market. And you can say, hey, well, that's because COVID. But if you even look up until the February peak in 2020, just about every sector in the market was up 30% during his administration. The energy sector was down over 25%. So, there's going to be other factors at play here, but drill, baby, drill is great for inflation. It's great for the consumer, but it's not necessarily good if you're selling oil. And oil's all about supply and demand. And when you have even small increases in supply of oil on the market, it can have a big downward impact on prices.